Inflation is expected to be over 3% this year. And if you talk to regular everyday Americans, it feels like their cost of living has gone way higher than that. At the same time, the Fed has been very hawkish, saying their main focus is to bring inflation down and keep things under control. But at the same time they're saying this, they're planning to inject over $200 billion back into the financial system over the next 12 months. And that's where it starts to not make sense. Because if the main goal is to fight inflation, why are they adding more money back into the system? So let's start with what the Federal Reserve's job really is. Because at its simplest, it's to keep prices stable and keep employment high. When inflation surged to its highest levels in 4 decades after the COVID pandemic, the Fed responded aggressively, raising interest rates from near zero to over 5% between 2022 and 2023. And they started something called quantitative tightening, where they shrink their balance sheet by letting trillions of dollars of bonds mature without replacing them. The message back then was clear. There was way too much money created, and now they're trying to pull it back. And for a while, it worked. Inflation came down from 9% to something a lot more manageable, but it never hit that 2% low. And as of early 2026, inflation is still sitting close to 3%, depending on how you measure it, with core inflation getting even higher than 3%. And some parts of the economy, like services, prices are rising a lot more than that. Then you have rising oil prices adding even more pressure, and analysts warning that inflation could move even higher if that continues. So when you look at the Fed's official stance, it looks like they're staying disciplined. They're keeping rates relatively high, and they're trying to cool inflation. But the Fed doesn't just use interest rates to fight inflation. It also does something called quantitative tightening, or QT for short. And what QT is it's the process of shrinking the Fed's balance sheet, and it's supposed to work together with high interest rates to lower inflation. Think of it like rates make borrowing more expensive, and QT drains the actual money from the system. Together, they squeeze inflation from both sides. And if you look at the Fed's balance sheet, it peaked at around 8.9 trillion in 2022. And by early December 2025, QT had brought it down to about 6.5 trillion, a 2.4 trillion reduction over 3.5 years. And then the Fed stopped, not because they reduced the money supply enough, it stopped because the financial system started showing signs of cracking. In March 2025, the Fed slowed QT dramatically, and by October, they announced it would end entirely on December 1st, earlier than the market had expected. And at the December meeting, they didn't just stop tightening, they started loosening. The Fed unanimously agreed to begin what it calls reserve management purchases, basically buying treasury bills to maintain what it considers an adequate level of reserves in the banking system. And this is where it gets important, because the Fed insists that these purchases are not quantitative easing, because they're buying short-term treasury bills, not long-term bonds. The purpose, they say, is to keep enough reserves in the system so that markets don't get too illiquid and we don't have a financial crisis, not because there's anything wrong, but because there isn't enough capital to settle short-term borrowing. But at the end of the day, the effect is still the same. There's more money entering the financial system, their balance sheet is growing, and inflation is getting higher. And you can actually see this happening in real time. Over the past few months, the Fed has repeatedly stepped in with large liquidity injections, basically tens of billions of dollars at a time through overnight repo operations and emergency lending facilities. So why is the Fed doing this? Why fight inflation publicly while quietly adding liquidity back into the system? The answer is because the Fed is trapped. To understand that, you have to go back to what happened after 2008. Before that financial crisis, the Fed's balance sheet was under $1 trillion, bank reserves were minimal, and the system was relatively simple. The Fed could control interest rates with small adjustments because the overall system was much smaller and a lot less dependent on the Fed. After 2008, that changed permanently. The Fed flooded the system with liquidity through quantitative easing, first during the financial crisis, then again during COVID, and at the same time, regulations pushed banks to hold more reserves and safer assets. The entire system adapted to that. The treasury market grew massively, short-term funding markets expanded, and everything became more dependent on large levels of reserves sitting in the system. The Fed didn't just step in temporarily, it became a core part of how that system functions. And because of that, there's now a floor it can't go below. If reserves fall too much, banks start holding on to cash instead of lending it, short-term rates become unstable, and the entire system can freeze up very quickly. We've already seen what that looks like in 2019, because in 2019, a sudden liquidity shortage caused repo or overnight rates to spike, and it forced the Fed to step in with emergency support and stop tightening earlier than expected. That moment showed that the system breaks much sooner than people thought. Fast forward to late 2025, and you start seeing similar conditions again. Reserves were getting close to levels that had caused stress before, and some of the buffers that used to absorb excess liquidity had largely disappeared. At the same time, short-term funding markets were starting to show signs of strain, and you started to see rates drifting up and pressure building even without the Fed raising interest rates. So the Fed had a choice: keep tightening to fight inflation and risk breaking the financial system, or ease off and stabilize things. And it chose stability. It slowed down tightening, it started adding liquidity back in, and expanded access to emergency funding. And the real problem behind all of this and how it affects everyday Americans is if the Fed can't drain enough liquidity to bring inflation down to 2% without the system starting to break, then the problem isn't just that 2% inflation is hard to reach, it may not realistically be possible under the current structure. The balance sheet has gone from under 1 trillion before 2008 to over 6 trillion today. And even after years of tightening, the system struggled to handle that reduction. And now it's starting to grow again, and at the same time, the system itself has changed. There's way more cash in circulation, a lot more dependence on reserves, and more reliance on the Fed to keep everything functioning smoothly. The system that existed before '08, that was a lot smaller, simpler, way less dependent on the Fed, is gone. And what's replaced it is something very different. A system that requires the Fed to stay large and stay active and constantly balance between two risks: letting inflation stay a lot higher than 2% or tightening too much and breaking parts of the financial system. And that's the real problem. Not necessarily that the Fed is making the wrong move, but that the system it's operating in, whatever decision they make, the economy is going to go through some kind of pain, even if that ends up being a recession.